going to be a long session. It's just testing the waters. Mr. S has been pushing me because I had indicated to him that sometime during the year I'll have other commitments. So it seems he had you guys in mind to say, okay, can you push them if it means completing before you leave, so that they will be in a position to do well in these modules. All right. So that explains the push to have the session coming slightly earlier than your college. All right. Now, ladies and gentlemen, welcome once again. I appreciate your time. I see familiar names. Appreciate that. Thank you so much. Congratulations to those of you we've made it in the previous modules, financial accounting. Those two modules were quite very easy. This one here will be slightly different, kind of like a module that I really love because it speaks proper accounting. All the other things that we've been doing, well, they just had a flavor of accounting. And I never enjoyed them so much. This one is the real thing. So you are set to enjoy, and you're getting closer to being accountants. All right, thank you, Edith. There, thank you for keeping to your word and taking us through our year 3. Yes, thank you so much. You did insist that I should come back, and you and the others plus Mr. S. I think you were literally pulling me by my lapels to ensure that I honor the promise. All right. All right, Stephanie, your FA2B, I don't know what happened in the exam. It was my lowest exam mark ever. It was the theory paper. Oh yes. Oh yes. But I'm glad you were able to go through it and then pass, so that you can do well on this one. Actually, if you intend to start further, most universities will be looking at this one because it's like a proper accounting paper. All right. Maybe the other thing that we should also get to understand is that the papers will get to be more and more theory because we are now applying the standards, and we will make an effort to explain to you about that. Thank you so much there for that, Stephanie. Okay. All right. Thank you so much, guys. Those who are joining us, welcome. And maybe for the sake of those who just joined us today, thank you, Singer. There, I see you too. Right, Edith, Malcolm, Nom T, and me. Right, Ishajayo. I think some of these are new names. All right, maybe just for the sake of those who are joining us for the very first time, Mr. P for short, and I'll be taking you for this module, Group Financial Statements and Taxation. It's a nice module, so to speak. Maybe those of you are joining us as well, you would want to know the qualifications that I have. I've got a master's in accounting sciences from the University of South Africa, that's UNISA. I do have a tax degree from the University of Pretoria. Just to mention a few of my qualifications, and I was also a student last academic year, and I did pass my CTA with a distinction. I think it really makes me happy because if we are to talk at this level, we need to talk from a position where we know, not a position where we claim to know. Okay, thank you so much, Eddie. Thank you so much, Stefan. Appreciate that. But ladies and gentlemen, I owe you a distinction on this one because it's kind of like my type of module. Now, in tonight's session, just for intro purposes, we're just going to look at unit number 1. Unit number 1 is a teaser of the whole module because it tries to bring you up to speed in terms of the basics that you may have forgotten from your matric, and some people may not have done accounting at all. So we need to bridge that gap. So that's typical of unit number 1. So I'll spend maybe the next 30 minutes or so trying to explain unit number 1 in the preparation for the second unit, which is going to be examinable. Okay, just back to the charts there. Thank you so much, Ihlajwa. They appreciate that. Thank you, Singh. Appreciate that as well. Thank you. All right. So in tonight's session, guys, we shall look at income and deferred tax. I just love deferred tax because a lot of us, those of us who claim to be tutors, we don't do justice on that part, and it becomes the physics of accounting. But we'll simplify that so that if you were to go back and get to meet maybe someone who may not do justice to this, you will still enjoy. And remember, guys, this is at NQ level 7. What it means is that you are just but a step away from your honors. NQ level 8 is your honors. You can do a postgraduate diploma in accounting science, or you can do a BCom honors in accounting, because as soon as you finish NQ level 7, you then qualify for an honors. All right. Now let's just touch a bit about the objectives. These are some of the things that I want you guys to know at the end of this session. We shall introduce you to this module, GFS and T. That's your group financial statement and taxation. You know, when I look at them calling it group, I thought they were gonna bring the real thing, the group accounting part, but you know, they just gave you a tip of the iceberg. Maybe they're so scared to bring the real thing. So that gives you an advantage because you won't get to have it that detail. So it's a bit of it, just giving you a flavor. The text part of it is just misplaced because it's not necessarily text, it's deferred text there. Right, then we'll also talk about the associated IAS and IFRS. Welcome, ladies and gentlemen. This is accounting proper. You know, in the past, in all those other modules that I did tutor you, I kept on mentioning that there are certain things that I want you to know because it was a build up to this module. Now, when I talk IAS, I'm actually referring to it as the standards. I stands for international, A, accounting, S standards. Now, gone will be the time when you just do accounting like you are doing history. Now, this will be guided by the international accounting standards. The accounting you will do now will resonate with the accounting that is done by a professional accounting firm, for example, because you are complying with the standards. You will notice that besides the IAS, you also talk about IFRS, that's the International Financial Reporting Standards. Your university does shy away from mentioning those things so often, but when you look at your module guide, it's replete with that. But they don't bring it out so often because I don't know why. But we will make an effort to ensure that as you finish this module, you don't get to a pass. You also get to understand why these standards are important in doing accounting. So we will so many times talk about international accounting standards. We'll talk about international financial reporting standards. Someone sitting there, ladies and gentlemen, will be saying to me, how does these two relate? If they are standards, why don't we just have one set? Why don't we have IAS only? Why do we see IFRS, which we call IFRS? Now, you'll notice that when we deal with accounting, there are some aspects that will be addressed by IAS. And there are some aspects that will fall under the ambit of IFRS. I will explain as we proceed. Let me just check with the charts there. All right. Okay. All right. All right. Thank you there. Thank you there, Namti there. Okay. All right. So please, you must be alive to the fact that we shall be talking about international accounting standards, and you shall be talking about international financial reporting standards. There isn't any difference between someone who is doing um, a psych-based degree with you. The advantage that one is listed as psych, yours is not in terms of this module, but otherwise the content will look like the same. Maybe the questioning techniques will be different. For someone who's thinking of bridging off to be a chartered accountant, this is the thing that you should hold on and ensure that you get to understand quite well. I had a student from this group, I think she actually branched off to do the psycho-oriented program, because she wrote me an email to indicate that she should want to go that route. All right, let's get to look at the second objective. Now, we shall also talk of types of taxation. Okay, another thing that they misplaced there, but well, it's our university. Let's get the results and go. And then the next one is income tax recognition. All right, the majority of you already are familiar with word recognition, because I kept on harping on initial recognition in our previous module, where I said to you, for anything in accounting, there's a start where it is recorded. And the process of recording for the very first time is called recognition. And when we remove it from our books or from our records, we call that derecognition. Now, in this module, they want us to introduce you income tax recognition. They're simply saying the very first part when income tax is captured in our records, we call that recognition. And maybe while you are still there, there's recognition at the beginning. It's called the initial recognition. And then at the end of the year, when you evaluate what you recorded previously, we call that subsequent recognition. We shall talk about that. And then we do have here income tax measurement. And our emphasis on this unit number 1 shall be around the current. Now, measurement, simple say calculations. That's the accounting speak, ladies and gentlemen. They're simply referring to calculating income tax. And which one? The current, meaning for this current financial year. Because you may have the amounts which are outstanding from the previous year, and you may have the amounts that should be payable in the coming years. So our focus for now will be for that current year, as opposed to those that come in the following years, which we shall talk about in unit number 2, which we call deferred tax. Now, we shall also talk about the income tax payment. Okay, income tax payment there. All right, thank you. I'll mute everyone. I think, okay. Let me mute everyone. Thank you there. Okay, thank you. All right, so income tax payment. Now, at some point, we need to be able to be remitting a certain amount of money to SARS. And now, when we talk of payment, it's not necessarily one direction where you pay as a taxpayer, tax to SARS only. There are some instances where you find yourself having paid more and SARS is supposed to pay you, and we call that a refund. It's a kind of payment too. So we shall address that under that particular objective, income tax payment. The difference between what you're supposed to pay and what you exceed in terms of payment, it will be referred to as a refund. But if there is a shortfall, we should also account for that. And then the next one is introduction to deferred tax. That's the main one I really want in this module. You will be introduced to so many terms where you are going to say to you, if you look at tax calculated on profit and the tax that SARS calculates, there are always some differences there. And we will explain to you in unit number 2, why are there differences between what SARS gives you as an assessment and what you would have calculated on the basis of your records as profit. And then we shall talk about disclosure. In other words, how should it appear in the financial statement? So it's all about knowing the various types of tax. It's all about measuring that. It's all about calculating that. It's all about then recording. How does it impact the financial statement? And we call that disclosure. Each time you see this word in accounting, disclosure simply means whatever you recognize must find its way in the financial statements. So that's the last part, which we shall look at there. Okay, so those are the objectives, ladies and gentlemen, for your group financial statement and taxation unit number 1. Now, let's just remind the people of the syllabus so that we don't get ourselves straying too much. We need to abide by this so that we get to pass. So group financial statement taxation, this module has got the following topics. Unit number 1 is income and deferred taxation. The bulk of it is income tax, and it introduces you a bit to deferred tax. But deferred tax will be done properly in unit number 2. That's the most interesting unit of your module guide, deferred taxation. If I get that one understood by each one of you here, I think I would have achieved my objectives, because so many people get really lost on that area. So unit number 2 is going to be deferred taxation. And then number 3 is going to be financial statement policies, estimates, and error correction. Another very wonderful and awesome unity. And may I also ask ourselves to disabuse ourselves from the notion that accounting is about calculation. When we talk unit number 3, by and large, ladies and gentlemen, there won't be any calculation. You need to be able to look at IS 10, where we are applying the policies, the estimates, and then error correction there. So it will be a theory type of question. And don't be scared. We'll simplify that. It's an easy one. And then provisions and contingencies. That's another theory part there. Provisions and contingencies. In financial accounting 2A, you were taught the elements of financial statements. You did talk of assets, you did talk of liabilities, you did talk of equity, expenses, and then income. You guys know all those things and how we recognize them. But we also now introduce you to some things that are almost closer to liabilities, but they're not liabilities. And we call those provisions. And they look like liabilities. They almost read like liabilities, but they vary from that, and we call those provisions and contingencies. We shall address that when we get to that part in that unit. And then this is going to be the next unit is going to be impaired assets. I love that one because you already have got an intro from financial accounting 2B, and I think the majority of you must get a lot of marks on that one. It's kind of like being repeated. And then the last one is going to be group financial statements, where we may have to do full-fledged financial statements for a group instead of an entity. Remember, a group comprises of different companies that fall under that group. So we need to look at how we do the integrated accounts for such groups there. So that's going to be your modules, ladies and gentlemen. Your syllabus looks like what you have there on my screen. Right? It looks very compacted, very small, but believe you me, the questions are a bit longer than normal. So we need to dedicate quite a lot of time around that and ensure that we pass. And the majority of these units will be theory, except for group financial statements and impaired assets, as well as deferred taxation. There will be calculations there. All right. Now, oh yeah, before I get you guys a bit scared, let's get the easy side of things, the introduction, unit number 1. It introduces you to the types of taxation we have in SA. All right, let's have someone there in the chat. Thank you. Right, thank you, Stephanie. The old admit us a bit rusty. Please teach us the baby steps again for what we covered last year. Oh yes, thank you so much. I will definitely do that. All right, we will definitely go that route. I like it. I like it. I like it. We shall definitely go through baby steps until we get you back to crawling, and then before you know it, you guys will be running as usual. And I know through the baby steps, Edith will be quiet, and when you start running now, she will be at her usual best. All right, thank you so much. Thank you so much, Audrey. Thank you so much. Oh, you are back. You are back, Audrey. We thought you got yourself your CA, your chartered accountant's certificate, and then you get sent us. We are glad you are still here. Thank you so much. Welcome once again, Audrey. All right. Types of taxation, guys. So these are the basic transactions that you'll have. The first one is called the transactional tax. Just let the name suggest, it's actually based on a transaction. And loosely we refer to this as VAT, or your value-added tax. It's so common. We are so used to it. At some point, I think 1991, it was around 10%. It went to 12%. It went to 14%. A few years ago, it went to 15%. I'm not very sure whether the coming fiscal policy that will be announced this month by the Minister of Finance, whether they were going to take it or they will leave it as it is, no one knows. But in 1991, they enacted the VAT Act, and they introduced this so-called VAT, and we refer to that in your module guide as a transactional tax. We'll explain why it is so. And then the next type of tax is your employee tax. I think the majority of us are familiar with that one. It comes in the mold of pay as you earn. At some point, I'll explain to you before the pay as you earn, there was a tax that was called site. And then it was developed into pay as you earn. That will explain that. I wish I was actually going into tax proper because I'm a tax person, but we don't go that deep. Right. The next one is going to be income tax. All right, income tax obviously is based on tax, on income, sorry, and then dividends tax. Right. It's based on the dividends that you get paid if you own shares in a company. And then we've got generic taxes that were thrown them in that umbrella that we call other taxes. We shall explain that very soon. Now, the other taxes include, among other things, your property taxes, right? Property taxes, for the lack of the right term. Well, they call it property taxes in your module, but let me not get there because we don't call that property taxes. There's a proper term, right? There's also fuel levies. I think we are used to that. The pump levies when you get to fill your car. There's on the price of fuel, the fuel levies. And then we do have unemployment insurance funds, your UIF. I think we're used to that. We have got your regional levies. These those that are charged in accordance to the bylaws in a particular municipality. So they vary. You will find that in Cape Town, they are not as similar to those of Joburg and so on and so forth. So we call them regional levies. Whoever wrote this module was a bit a miser. They were a bit lazy because I was expecting them to unpack. They left quite a number of tax systems. I would have loved them to talk about estate duty. I would have loved them to talk about donation tax. I would have loved to talk about CGT, which is capital gains tax. I wonder why they didn't introduce it at this stage, because you can't talk deferred taxation without having to talk about those. All right, but for now, at the introduction level, unit number 1, they brought in this one. I don't know whether they had a degree in mind or they just had a matric student in mind. But ladies and gentlemen, these are the types of taxation. Number 1, your VAT. Number 2, your employee tax. Number 3, your income tax. Then number 4, your dividends. And we've got disaggregated taxes. And the examples are property taxes, fuel levies, UIF, regional levies. Just got this straight away from on a word-to-word basis from your module guide. I didn't want to distort that because I would have added something that would make a bit more sense. All right. So these are the types of taxes. If you had asked me, what are they likely to bring for your exams, I can guess that there will be likely a question on VAT. You need to calculate VAT that is supposed to be payable or refundable from SARS. That one you must be able to do. And then employee tax. It's likely to be there, but it will come under deferred tax. So we shall explain those things as we proceed. Now, ladies and gentlemen, legislation for each type of tax. This is an activity on your module guide. I just thought maybe just to let you be a bit come back. This whole day amnesia. People get forgetful. They forget certain things when they come from a long, long holiday. And the things like words from a book are easily forgettable because they are uncomfortable. As a way of just bring you back, I want you guys to, after this session, go and check on these pieces of legislation that relates to particular types of tax. Like, for example, I given you the first one there. Your module guide just threw them to you guys. They didn't answer them. I think they want you guys to go and research. You can even get it from AI. You can even get it from the normal traditional Google. It will always give you this. Right, value added tax. Now, the legislation applicable there is Value Added Tax Act of 1991. All right. So before then, we never had VAT. It was only introduced by that piece of legislation on that particular year. All right. And then I want you guys to look at employee tax. Tell us which piece of legislation is actually going to determine your employee tax. If we were teaching you taxation, we were going to say to you, employee tax is part and parcel of individual tax, and they fall under the ambit of one legislation. And let me not let out the answer. I want you guys to go and find out the piece of legislation for employee tax, and then dividend tax. Go and tell us the dividend tax. Read around that. I also want you to look at the withholding tax, which is 15%, meaning that if you were to be paid your dividends from a company, the company that pays that dividend is obliged to remove a certain percentage and hold it back before they pay you. And then they remit that to SARS. We call that withholding tax. Same applies to royalties. Let's say you're an artist, for example, coming from abroad. You come and sing here, and the organizers of your show are actually compelled by law to take a certain percentage from your gate takings or from the income you generated, so that they can remit it to SARS. We call that withholding tax, right? So the law is very clever. You can imagine you come here, you have got a nice show, and then no one looks at how much you're supposed to pay, and then they base it on your trust, and they say, when you get back home, please pay us. You can even tell them that you didn't raise that much. So the law has this thing of saying withhold the amount before you pay the individual who's supposed to be getting the income. Just like you see with dividends, just like you see with employee tax. The employer is compelled by the law to tax you before they pay you the amount after tax. Now, there's this new one. It was introduced in 2001. I don't want to mention the legislation because CGT is one very interesting piece of legislation. The capital gains tax. That's another one. Your module guide has introduced value-added tax. They've got employee tax in that activity. They've got dividend tax. They left out, I don't know how, they left out capital gains tax, and I put it there. I want to get excited around it because we can't do deferred tax without mentioning how the asset is disposed, right? If an asset is held for sale, or was it held for use, and we'll explain that. You find that we apply CGT there. So please get excited as well around capital gains tax. Your module guide left that one out by accident. I don't know how. All right, so these are the types of tax, and your homework is to find the pieces of legislation for the remaining three there. I think it's easy for people to do that. Let's get to the proper one here, your transaction tax. And you really are lucky. In my opening sessions all the time, I never get to teach something from the first unit. I will always tell you about, now I'm growing old now. I always tell you about who I am. I always tell you about what I studied. And now I'm an old man now. I don't mention those things. So I decided to go straight into the unit there. All right, thank you so much there. Okay, now let's get to look at transactional tax there. And we say this is going to be VAT, guys. And this VAT is derived from transactions, like I already mentioned. In other words, when a transaction takes place, um, tax is calculated on each and every transaction. And that tax which is calculated is referred to as VAT. In SCA, it is referred to as value-added tax. I think I've already mentioned that. VAT is only paid on the supply of goods and or services, right? This type of tax, it's only based on the supply of goods and services. I did explain a bit further than what your module guide does, because I wanted you guys to link up this with your workplaces. Some of you are working in accounting environments. So I loaded a bit of info to assist you. The business are obliged to charge VAT on behalf of SARS and to pay it over to SARS. So businesses are like agents. They collect this when they do their businesses, and they then remit it to SARS. Now, VAT is charged on taxable goods and services. I think we already mentioned that. Since 30 September 1991, value-added tax has been levied in RSA in accordance with the Value-Added Tax Act of 1991. We have mentioned that already. Any person who runs a business with a turnover greater than, oh yeah. Now, what we need to know, guys, is that it's not everyone who is compelled to include in their price the amount of VAT. We do have what we call a VAT vendor. A VAT vendor, it's not someone from Limpopo, guys. A VAT vendor is someone who is registered for VAT purposes. And who is supposed to register? There are three types of registration. Number one, we do have what is called compulsory registration. Now, if your business in a space of 12 months generates at least $1 million turnover, that business is compelled by law to register for VAT. Okay, so let's check there on the charts. Oh, thank you there, Klaja. All right, thank you so much. All right, so if your business generates a turnover, just sales in general, about at least 1 million, 1 million and above, that business is compelled by the law to register for VAT. So that is called compulsory registration. It's not optional. You are actually forced by the law to register. Then we've got the second type of registration. If your business makes less than $1 million, but above 50,000 rands, at least 50,000 rands, but less than $1 million, in a space of 12 months, that business can do what is called voluntary registration. Voluntary registration is optional. You do it at your own volition. You can register, you may not register if you want. And someone may say to me, why would a business that is not forced by the law to register decide to register? There are quite a number of advantages. Usually, a business that is registered for VAT is viewed in good state by other businesses. If you want to conduct business, there's always that need to provide them with that number, and it makes your life around the business world a bit more easier. So quite a number of businesses have got to find that motivation to register. And in the past, in that era when everyone thought doing business with the government is the thing, and we then decided to call that corruption, because it was not above board. No, there was an era in the history of our country, not so long, when everyone thought that if you want to be a millionaire tomorrow, then do business with the government. And they called it the tender period. And we had so many tenderpreneurs mushrooming everywhere, and they were driving Porsche cars. Now, those people will be required for them before they could be issued with a tender. The government would always insist on VAT registration number. That was the only thing that they were looking at. Whether that money will never go to infrastructure and so ever, they never bothered. So it was just, so those type of businesses would find themselves registering even if the law does not force them, because they want to access those benefits from the government. That's just unique to South Africa anyway. There's the last group of registration. If your business makes less than 50,000 rands per annum, that business is not supposed to register, you can't register. So 3 types of registration. We do have compulsory registration. Number 2 is voluntary registration. Number 3, you can't register. Your sponsorship is not good enough. So that's what the law will say under that act. Right. Now, ladies and gentlemen, we also need to understand that VAT is charged at accordance to the categories of supplies that you make or that you supply, so to speak. Now, the type of goods you supply will determine the rates of VAT. Yes, the standard rate for everyone is 15%, but it's not everyone who pays 15% or who are supposed to include 15% in the price. It depends on the goods you supply. So let's get to see those. We do have what are called vetable supplies. I think we all know these ones. They are charged VAT at the standard rate, which is currently 15%. And remember, this here can change depending on the pronouncements from the Minister of Finance. Then we've got zero-rated supplies. Today, as you see there, ladies and gentlemen, I know theory is not all that nice, but I'm convinced that as you get to be closer to being accountants, you'll find that accounting at that level is actually theory. I keep on saying to you guys, I was writing CTA. I want you to go and find out what the abbreviation CTA stands for. It has got the word theory there. Competence theory of accountants. So for you to be a CA, you have to qualify by writing the CTA exams before you write APS exams. So the CTA exams, that T that you see there means theory, competence theory of accountants. So from grade 12, you do calculations. That's why people think that if you don't have maths, you can't do accounting. But as you go deeper into being an accountant, you'll find that, oh yeah, the figures are not even very useful. After all, we have got softwares that can do the calculations. Even basic calculator can do the calculation. So knowing how to calculate is not the main thing in accounting, because a machine can substitute you. But we need you to think what should be loaded in the machine, and that's the theory. All right. So now we are talking about the rates. I've already introduced standard rate for vetable supplies, which is 15%. Glad everyone knows that. And then zero-rated supplies. This means that the percentage is going to be 0. Now, I want you guys to understand that when we say zero-rated, don't say to them, VAT is not charged. 0 and VAT not being charged are 2 different things. In maths, they are the same. At law, they are different. I'll repeat this once again because quite a lot of people, especially those who are not taught by people who have done tax, when we say VAT is charged as 0%, and we say it is zero-rated, more often our students think these are the same, they can be used interchangeable. When we say it is 0, it is charged, but at what rate? It is 0%. When we say it is zero-rated, it is not charged at all. Guys, if you can get that difference clear from get-go, you will never have a problem. Because at some point, you guys will need to fill the VAT 11 forms where you do the claiming for VAT. You can't claim for zero-rated supplies. But if you charge at zero-rate supplies, which is 0%, you can claim because it is a charge of VAT, which is 0%. So you can claim. But when the supplies are zero-rated, you can't claim for that. So you can claim for 15% charges, you can claim for zero-rated supplies, but you can't claim VAT for anything that has been zero-rated. All right. Now, maybe just a bit of this zero rating. It's usually for essential goods. I think me and you know that, like your brown bread, eggs, maize meal, beans, fruit, vegetable, paraffin, sardines in a tin, cooking oil, rice, milk products. All those are zero rated. It's a deliberate stance by the government trying to make sure that everyone has got access to these basic commodities. Now, exempted supplies, these are no VAT is charged. I just had to write that for emphasis purposes. Now, you've got your financial services, like for example, interest, your life insurances, medical aid, and pension funds. All those are zero rated. Then you've got your bus, train, and taxi passenger fares. They are zero rated. So they're exempted. Please don't get me confusing you there. They're exempted, not zero rated, they're exempted. Then you've got educational services. Like when you pay fees to your university there, they're actually, the fees are zero rated, exempted, sorry, they're exempted. Then you've got renting of accommodation for use as a private home. But if it's a hotel, if it's a lodge, if it's a motel, it cannot be exempted. There will actually be 15% there. Then you've got salaries and wages. I think me and you know that they are exempted because they already get a tax which is called employee tax. And then we've got hobbies, private recreation pursuits, all those are exempted. Private sale of personal and other domestic items. If you decide to go and sell a watch, for example, it will be exempted. The supply of goods and services by welfare organizations, all these are actually exempted. So we have got three types of VAT charges. Number one, we have got your uh, vertebral suppliers, two zero rate suppliers, and the last one is going to be exempted suppliers. I decided to just load this a bit with a bit of info just for interest sake for for your own use. All right. Then something that is always left out by people teaching this because there's so much that is assumed is the basic calculation. I'm glad Stephanie says, let's start with the baby steps, as if when I did this, maybe there was that uh, feeling that someone may request that I start from the basics. Now, when we do the calculations of VAT, we use the fractions that you saw there. And it's imperative that we get to know how these fractions are going to be applied. Now, the calculation depends on whether the transaction is VAT inclusive or VAT exclusive. So look at this word here, inclusive as well as exclusive. This will determine which fraction of VAT do you use. Don't look for this in your module guide. I just put it in there because I just had you guys in mind that you'll request that we do the baby steps. When we say it's VAT inclusive, you gotta use, remember we said it's 15%. So if it's VAT inclusive, we're gonna use 15 over 115. So if they give you an amount, say they sold goods for 4,000, VAT inclusive, so you're gonna use 15 over 150. So it's like they've added 15% on the 100 at the bottom there. So always remember, if it's inclusive of VAT, it's going to be 15 over 115. I could have changed this into a decimal figure, but it will look scary. So I just decided to do the basic thing, 15 over 115. And then VAT exclusive. If the amount says, the transaction says the amount given is exclusive, meaning it doesn't have VAT, you're going to use 15 over 100, which is 0.15, 15%, 15 over 100. Please take note of these because this will determine your calculations going forward. All right. And please, if you don't understand, feel free to ask as usual. I always ask people to be free. All right. So tonight we're just doing the basics. Don't stress. We shall get to the real thing. I know some people are waiting there pensively to say, why can't he get to the real stuff? We want to see it, calculations and stuff like that. We'll get there. Baby steps as usual. All right. And then, ladies and gentlemen, which vendors has to register as a vet trader? I think I've already said this way in advance. So you will read through this compulsory registration. I've already mentioned that. And then the voluntary registration. And then we also have someone who's 50 who is not allowed. Now, these are examples of transactions for vet. You see, cash sales 3,000. You see, in brackets, it says exclusive. You're going to use 15 over 100. The next one is exclusive, is going to be 15 over 100. The next one is going to be inclusive, is going to be 15 over 115. And this one is going to be 15 over 115, as long as you see inclusive. Exclusive is 15 over 100. And then bought goods on credit from Gulf Foods, 2,280 inclusive is going to be 15 over 115. And then unsatisfactory, goods returned to Gulf Foods 798. Obviously, that VAT which will be refundable is going to be 15 over 115 because it's inclusive there. Okay. Now let's get back to your module guide and get to talk about the ledger accounts. These guys are a bit tricky. They decided to demonstrate the ledger accounts, but I've seen in most of your papers, they convert these ledger accounts into journals. So at some point, we need to collapse this into journals so that we demonstrate this to you, all right? Let me pause a bit here and allow someone to ask anything. We're still with the basics, of course, and I would want people to feel free about the basics. Anyone with a question there, please feel free to ask before we proceed. It won't be too long a session tonight. It was that type of a session where we get to regroup and greet each other and get to say I'm still around. All right. Okay. So any questions, guys, feel free to either put it on the chat. You can also unmute yourself and give us that in the form of um, a question. But let's get to look at common ledger accounts peculiar to transaction tax. Now, ladies and gentlemen, by and large, when we talk of ledger accounts, they will be determined by the nature of the transaction. Your module guide is, and even your textbook, Gripping Gap, they shy away from mentioning this. I don't know why. They're scared of making you feel like you are grade 12s. But there isn't anything special about this part. It's grade 12 stuff. Because we need to tell you that there are two main type of transactions. We have got the sales and the purchases. The sales represent what you acquire as income that which accrues to from either providing a service or the goods. It also can include even other forms of income ancillary to your business. And we do have purchases which can mean the purchase of inventory, purchase of an asset, or even payment of an expense that will be put on that part. So there are two main groups of transactions if we were to look at that. But let's start off with the most basic one, your sales. You know, I used to say some years back when I volunteered to tutor the grade 12s who were about to write exams. I'll tell them, guys, if we talk of sales, look at the movement of the goods. When you are selling, the goods go out. If I were to use layman's language. So the VAT you calculate there will be called VAT output. Movement of goods, they're going out, you're selling them. So it's VAT output. And when you are buying purchases, the movement of the goods is towards you. So it's going to be in. So you'll have VAT input. And in grade 12, your job was to identify the VAT input items and the VAT output items. And the difference between the input and the output items in terms of VAT will signify what you're supposed to pay to VAT or what VAT is supposed to pay you. But with you guys, instead of using the word VAT output and VAT input, they decide to get closer to IAS 12. They substitute output with payable and they substitute input with the receivable. Right, let's get to look at the sales there. Now, the accounts we shall have when we deal with the transactional tax relating to sales is to acknowledge or to recognize the income you get from selling anything, whether they are goods, whatever, even an asset, you get the income from that. And that income, if it's in the form of cash, will be recorded in a bank account. So you find the amount will be reflected in the bank account. We shall talk more about that. And then the second account is your sales. For every debit entry, there's a corresponding credit entry. So if you sell something for 25,000 rands, in the bank account on the left-hand side, you'll have 25,000 rands. And then on the sales account, you'll have 25,000 on the credit. So that's the two accounts you'll have there. But as we do that, we must not forget that 25,000 may be split into the amount that belongs to the business and the amount that is supposed to be remitted to SARS in the form of VAT. That amount, which is supposed to go to VAT, will then be reflected in your current tax payable. And this is your VAT account. Why do we call it tax payable? Because when you sell, you collect the amount for the price of the product. Included in that amount is VAT. And when you collect it, it is not yours. You are supposed to pay it over to SARS. Hence, we refer to it as current tax payable. In essence, it's a liability. You owe it to SARS. More often, businesses get into trouble because when they collect that money, they think it is theirs and they put it into use. And when SARS starts reconciling the records, they are found wanting because in their bank account, that money is no longer there. So when it comes to sales, you must remember that the sales will come with a liability you owe to SARS. Because in the amount you collect from your customers, there's that 15% portion which you are supposed to remit to SARS. And hence, we use the word current tax payable. So for sales, which is your level of accounting, they didn't want to complicate your life, you will have to know these three accounts. Okay. And then let's see. Purchases of inventory is kind of like the opposite. In as much as sales results in a liability which is called current tax payable, the purchases of inventory gives you an asset because SARS is supposed to pay you that amount of money. You are paying to your suppliers. In the amount you pay, there's that extra 15%. So that extra 15% at some point is receivable to you. So let's see the accounts involved there. As usual, you'll have your bank. This bank will not have a debit balance. It will be on the credit because you are giving away cash. And then the second account is going to be inventory. You are buying goods for sale. We call that inventory. And because you're increasing them, they will be debited. So it will be on the debit side. And then the next one is going to be your current tax payable. Look at me. I think we need to correct that one. It can't be tax payable. It's supposed to be current tax receivable. This thing of cutting and pasting has let me down there. I'll correct that before I pause. Supposed to be receivable because you have got payable under sales, but under purchases, you are supposed to have a receivable because that money is claimable. It should come to you. So now, if you sit there listening to me, you're like, yeah, this guy is confusing me now. So does it mean that every time I purchase my inventory from my suppliers, I must get some money from that? The answer is, in theory, yes. But SARS is clever. They will say, before we pay you for this, wait a minute to see if we don't owe you. You don't owe us. So they will net the difference between what you owe them and what they owe you. If the amount that you owe them exceeds the amount that they owe you, it means you need to pay them the difference. But if the current tax payable is smaller than the current tax receivable, it therefore means that they now owe you, they'll give you a refund. So all the time, before SARS pays you back a refund on VAT, they will compare your current tax payable and your current tax receivable. So the refund will depend on which of the two is bigger. Should you have a shortfall, you are the one who is supposed to pay up the difference. Okay. Now, ladies and gentlemen, let's get to do only just this example and then we'll call it a night. My idea was just to do this for 30 minutes before we call it quiz. This example comes from your module guide. I'll just change the name, of course. John is a registered VAT vendor. The current VAT rate is 15%. Goods were sold for 1,000 rands, excluding VAT. And ladies and gentlemen, those of you who have got the module guide, you check this, it's actually on page 15, where it says Mrs. Naidu. I just changed the name there. Now look at this here. The emphasis there is that word excluding. because it will affect the fraction you use in calculating VAT. Maybe just while you are still there, because your module guide is mute on that, let me just ask you, which fraction are you going to use to calculate VAT there? Is this going to be 15 over 115 or 15 over 100? Right? I'll pause a bit and get the answer for that one. Anyone who can please? Which fraction do you use? 15 over 100 or 15 over 115? All right, someone there in the chat. Okay, 15 over 100. Thank you so much, Nomti. Yes, thank you so much. All right, let's see. There's a second answer there. Stephanie, 15 over 100. Yes, thank you so much. Because it is exclusive of VAT. So when you're doing your calculation, always check that. In your module guide, they went straight to do the ledger accounts. They assume that people may are familiar on those calculations, but I just said to bring it in so that we don't get caught up in the exam. Prepare the necessary ledger accounts to record the sale, the liability, and the payment of VAT. Right, calculations. I just introduced this, it's not there in your module guide. 15 over 100 times 100, and then the answer is going to be 115. And once you've got that 115, then how then do you show it in the ledger? Right, so the first account, like I mentioned, is going to your bank. Right, when you make sales, you are actually going to receive money from the sales. And the amount of money you receive is going to be called your sales. And so the sales is going to be 100. It's going to be 1,000 as per transaction. Now, I want you guys to understand that if the sales were said to be inclusive of VAT, it was going to be reflected on the transaction as 1,150. And when you are recording it here, you can't write 1,150. You are going to split that amount into the sales amount and the VAT amount. But with this amount, it was a simple one. You had an amount exclusive, so which is amount without VAT. So we are going to record that as 1,000 on the bank account on the debit side, because it is being deposited in the bank. So you debit the bank account because it increased on the left-hand side. And then the second one is going to be a VAT account. And this VAT is going to be current tax payable. They decided to call it first entry. You don't do that in the examination. Just know that it's current tax payable. And the amount is going to be 150. And at this one here, you will only get to write it at the end of the month when you're now paying that amount to SARS. You're going to credit that amount because you're owing it. And then when it's time to pay, it has to be moved from the bank account. That's why it's on the credit side. This is a very confusing entry that your module does. It assumes like, it feels like you are actually doing it at the same time. You would have recorded these two during the course of the month. And at the end, when you now have your records completed, you'll enter that one to acknowledge that you're now paying that from your bank account. So please don't get confused by those two. Now, the second one is going to be sales. This is typical of basic accounting. For every debit entry, this 1,000, there must be a corresponding credit entry. You debit bank account with 1,000, and then you credit sales with 1,000, bank being the contra account. I love this one because it's actual basic accounting. If you've got a brother, a sister, or a daughter or son who's still at high school there, you can sit them down there and start telling them, I know this stuff. And it's just but similar. And your university has got this thing of wanting to make everyone have something to write in the exam. These very things that look very innocent and too easy, they may pick them up in the examination. Instead of bring ledger accounts, of course, they'll bring the journals, which is just the same thing. Okay. Now, the last one is going to be your current tax payable. That entry there, which you put on the debit there to complete double entry, it will be put on the credit there, 150. And then what does this mean? This is a liability because all liabilities has got credit entries. And then at the end of the month or the year or the tax period, when you now know how much you're supposed to pay, you then pay that amount. First, you remove it from the bank. and then you complete double entry by putting on the debit side. So that's why it's VAT payment. This one is the payment part. This comes at the end. In the examination, they may even not ask it. When they say record the ledger accounts, they don't mention the payment part. You don't include this one. All right. I don't like the style because it adds a lot of layers. At times, it may confuse some people who are doing accounting for the very first time. All right. So these, ladies and gentlemen, are the accounts for that transaction, which leads to transaction tax. And which is the transaction tax? This is the transaction tax. Your VAT there, your VAT payable there. All right. Now, this year are the accounts relating to your purchases of inventory. I didn't complete those ones deliberately because it's repetition. You'll obviously have your bank there. You'll obviously have your inventory. You'll obviously have your current receivable VAT account. So you see, in the purchases, instead of having current tax payable, you have got current tax receivable. In our next lesson, I would want us to be in a position to do these two accounts, current tax receivable and current tax payable. And when we compare those two, the difference between them will determine whether you are being refunded or salaries will ask you to top up what they consider as a shortfall from your side. Now, ladies and gentlemen, at the end of the two units, which is unit number 1 and the unit number 2, you must be in a position to complete this template. It's called the template for calculating taxable profit. Ladies and gentlemen, it doesn't matter which university you are at, whether you're at Menkosa, you're at UJ, you're at Victoria University or Cape Town, everyone does it the same way. It looks the same. I'm glad your review committee at university, I saw them putting up a review committee at the end of last day, and they're sprucing up a lot of your qualifications. They now give them different names, and the content that they now put there, they're adding quite a lot of things. It really makes it interesting and a bit more standard. So that's why I can say it confidently that this template that you see here on my screen is actually a standard one for all the universities in the world. All right, so we call this disclosure. At the end, when I have taught you properly, each one of you must be able to complete this thing. I don't want you to do it now. I just want you to think about it. I just extracted it from unit number 2 and put it there just to show you that that's the part that we are going to end it. Profit before tax, you adjust for permanent differences, exempt income, non-deductible expenses. Don't worry about those terms. We shall teach them to you. All right. I just put it there so that as we leave this session, no one leaves the session saying, so this module is going to just be tax only, VAT only. I think it's easy. We need to get to that part for unit number 1 and number 2, and that will be the end of income tax and deferred tax. Ladies and gentlemen, this was just but an intro. Just wanted you to say we are now on is, and Mr. S must be communicating the days on which we are going to have this one. I'm hoping our numbers will permit us to have a run through the next 2 months or so before I get to have other commitments. I'm promising you by the time we end, every one of you will be done with this module, and all you'll be waiting for are your assessments, and then you get it right. It's a very interesting one. I would really want to walk the walk with you, so to speak. Otherwise, ladies and gentlemen, this was just but an intro. I'll pause here, allow people just 2 minutes to ask questions, make contributions, suggestions, and then we call it a night. We still have taxation module with you as well. Oh, that one. I saw Mr. S trying to foist it on me. All right, let's hope we will take that aboard too. All right, let's hope so. Okay, glad to have you back. Okay, thank you so much, Sajwa. I appreciate that. Thank you so much, guys. All right, let's meet in our next. Thank you, Tracy. There. Thank you so much, transcriptions. Remember, we have been together all the way. Thank you so much. Appreciate. Okay, right, guys. Let's call it a night. We will have Mr. S communicating to you. Thank you, Audrey. Thank you, Stephanie. Appreciate so much. All right, let's hope. Oh, next session is on what? I don't remember the got this holiday amnesia too. Don't remember our next session the day, but I think Mr. S will communicate. Right, he just called me just 2 hours before the session so that I can put something. Thank you, Singer. Thank you so much. I appreciate. Or is Thursday and which day? Today is Thursday. I can't remember. He said it should be 2 days. Can't remember the other day. All right, but let's hope he's gonna communicate that too. I'm hoping you'll also go and tell me in advance so that I get also organized. All right, thank you so much. Thank you so much, everyone. Thank you. All right, thank you so much, guys. Let's call it a night. By Monday and Thursday. Thank you, Singer. Thank you for that reminder. Monday and Thursday. So it makes me uh, prepare the lesson on a Saturday, because on Sunday Arsenal is playing. I'm not touchable that particular day. All right, thank you guys. Good night, everyone. Bye. Let's meet on Monday. Thank you, Singer, for reminding us the second day. Thank you. Bye.
Thank you, sir. Bye.
Thank you so much. Appreciate. I'll end the session now. Bye.